Tonight, the massive IRS tax leak. It has revealed the wealthiest of Americans paying little to no federal income tax.
And after hearing this, I read over 2,000 pages of the US tax code to figure out how they do it. Today, I'm revealing tax strategies that actually work, and at the end of the video, I'll tell you what to start doing tonight to lower your taxes. But first, you need to understand how taxes work and why you need to lower them now. Okay, so when you work, the money you earn is called your pre-tax income. This is what the government looks at to determine how much to take. What's left over is your post-tax income. So we need to focus on this, because even if you just saved $5,000 from taxes, that could be worth nearly $35,000 in 25 years if you invested it. All right, so the first easiest thing to do to lower your taxes is on page 159. When you work a job, the usual tax process looks like this. Get paid, pay taxes, spend your money. But if you have a side hustle, a business, or freelance, the process switches to get paid, spend money, pay taxes. This means that you can now control the amount of your money that can get taxed. And as ridiculous as this sounds, lowering your income is one of the easiest ways to lower your taxes. But obviously, you want to take home as much of that cash as possible, so you need to do this very strategically. When I went full-time on YouTube a few years ago, I was super overwhelmed with taxes because it was my first time being fully self-employed. I had no idea what to do and I was stressing out. But thankfully, one of my friends who was studying to be an accountant said I can lower my taxes if I bought stuff for the business. And so I did. I bought stuff like this, this, and this, and this, and all these purchases cut down the amount of taxes I have to pay because I showed the IRS I had less money left over, aka my income, that they can tax me on. So if you're making $100,000 a year, then strategically buy something that'll help you grow your business or side hustle over the long term. If you spend $40,000 of that $100,000 on equipment, classes, or coaching, then the IRS will see you only making $60,000, which means you'll pay significantly less in taxes. Okay, so now that we set the base foundation in your head, we now have to go up a level to page 367. So Jeff Bezos paid $0 in income tax despite adding $46 million to his personal wealth in 2007. And I figured out how he did it, and you can do it too. For regular people like us, we view debt as a terrible thing. And yes, when it's not handled correctly, it definitely is. But debt is also one of the easiest ways to lower your taxes and pay less to the IRS. What Jeff Bezos and a lot of wealthy people do to generate little to no taxable income, but still be able to buy $600 pair of sandals that look like trash is this. These people have a lot of money tied to their stocks and other assets, and they take out a loan against those assets, which is where mastermind debt comes in. And you can do this too. Not buy the sandals, I wouldn't suggest that, but you can use that strategically with these 3 steps. Let's say you have $100,000 sitting in your stock portfolio. You want to access $35,000 from it, but you don't want to sell $35,000 worth of stocks because you'll have to pay taxes. So what can you do? Step 1, put that portfolio up as collateral to borrow 35% of your total portfolio value, or $35,000. And sometimes you can borrow even up to 60% depending on a few things. But here's the cool part. Although you now have $35,000 that you can spend however you like, you don't need to pay taxes on that money because this money is a loan. Now, you will have to pay back the borrowed money with interest, but generally the interest rate on this type of loan can be lower than other types of loan that you're more used to. And that rate can be negotiated depending on the total amount of assets that you have. Step 2. Now, the wealthy uses a small portion of this loaned money for their personal spending and the rest to invest in stuff that can make more money at a faster rate than the interest that they're being charged from the loan. So if they're being charged 3% interest on a loan but can invest that money and make 8% in returns, they'll still make more money. Step 3. With the profits, you can start paying off the loan. So in the end, you had access to untaxed money. But this is risky, because if something bad happens, then you could technically lose your collateral. If you don't want to deal with this collateral mess, here's something else I do. I live in New York City, so rent usually costs me a quarter of my left kidney every year. But thankfully, I learned about this. This is my studio, I film my videos here, write my scripts, and so on. So I'm able to turn this entire workspace into a tax deduction, which reduces my taxes. The tax code is filled with hidden deductions that you need to use to your advantage. How? If I paid $3,000 in rent and my workspace takes up 25% of the total floor space, that means I can take 25% of that $3,000 and turn it into a business expense. So in a way, I'm saving $750 in taxes per month and only paying $2,250 in rent, which adds up to a savings of $9,000 a year in taxes. I can also track the electricity I use and the business meals I eat. I can depreciate my equipment like laptops, business vehicle, furniture, real estate, a ton of different stuff, and it can all get really confusing. But there is something that can help. Look, I don't know about you, but I hate doing taxes. It's hard to understand, it takes a lot of time, and it can get really expensive. Literally all the worst qualities in one thing. So naturally, I spent hours looking for ways to make filing my taxes quicker, freer, and easier. All the qualities I do love. And I found Free Tax USA, who's sponsoring this portion of the video. And I'm super pumped about this because I've used Free Tax USA before, and they're pretty amazing. What's awesome is their website pretty much guides you through the entire tax thing. And it's free to import your prior year's tax filing information, so you can start right where you left off last year. Plus, it's free to file federal returns, and if you're self-employed like me, it's free to file federal self-employment returns too. State filing only costs $14.99, and this low price includes customer service support, tax extension, and covers all major tax situations. You can't get better than this, like literally, because I looked at pretty much everything. Go to freetaxusa.com/Vincent Chan to file your taxes quicker, cheaper, and easier. Thanks again to Free Tax USA for sponsoring this portion of the video. Now let's dive back into the two biggest things to lower your taxes, and unfortunately, a lot of people don't know this. Warren Buffett is worth more than $110 billion, yet he pays a lower tax rate than his secretary because of... Huh? Strange. I guess we haven't unlocked this portion of the video yet. Anyways, it's a lot easier to do than you think. So scenario one, you work a job and you earn $40,000 a year. Depending on your state and other factors, you'd be paying plus minus $8,000 in taxes. Let's stick with that number to make the calculations easier. That means at the end of the year, you're walking away with $32,000 post-tax. Not great. But in scenario two, you're gonna end up making $40,000 a year and actually pay $0 in taxes. Here's how. First, let's set the scene. You don't work right now, so you make $0 a year, but you do have money tied up in stocks that you held for longer than a year. The cool thing about this tax strategy is it plays with long-term capital tax rates, i.e. the rate that you'll get taxed on from selling your stocks and realizing those long-term capital gains. And the long-term capital tax rates come in three tax flavors. First flavor is if you sell your stocks and you realize a long-term capital gain of less than $44,625, you don't pay any taxes. Second, anything more than that, up to $492,300, you'll pay 15% of it in taxes. The third flavor, anything above $492,300, you'll pay 20% in taxes. Okay, now remember, you have $0 in income right now because you don't work, but now let's say you want to sell your stocks to collect $40,000 from that capital gain sale. Because you're selling long-term stocks, you have no other income, and since it's under $44,625 threshold, you don't have to pay any taxes on that sale. That means in scenario two, at the end of the year, you're walking away with $40,000 post-tax, compared to scenario one where you walk away with $32,000 post-tax and pay $8,000 in taxes. Investing funneling is how Warren Buffett pays such a low tax rate. A bulk of his income gets paid as dividends and long-term capital gains, which are taxed at a much lower rate than ordinary income. But it's page 1746 that's my absolute favorite way to lower my taxes. And it's perfect if you own real estate or have plans to get real estate in the future. It's not a secret that real estate is probably one of the greatest tax investment vehicles that has ever existed. Now, most people assume it's because the value goes up over time, but not even. There are countless tax benefits with real estate, and here's two. First is when you rent the property out, which sounds bad because rental income is taxable, right? Yeah, but not really. Let's say you buy a house for $200,000 and you rent it out for $2,000 a month. This means you'll earn $24,000 in rental income each year. That's a lot of money to be taxed on. But according to this, mortgage interest, property tax, operating expenses, depreciation, and repairs all count towards rental income expenses. And here's how this changes everything. Let's say your operating expenses, repairs, and insurance takes up about a third of your rental income. 33% of $24,000 is $8,000. That leaves you with just $16,000 of taxable rental income. Then you'll probably have to pay off some mortgage fees each month. Let's say you took out a $160,000 mortgage to pay for the house, which means you'll probably be paying plus or minus $800 a month towards the mortgage. So in a year, that's $9,600 of fees. So take that $9,600 out of the $16,000 of rental income, and this leaves you with $6,400 of taxable rental income for the year so far. The one thing you're forgetting is that your property is also getting older, and so you can depreciate your property, which is an additional tax break. Most US residential rental properties are depreciated at a rate of 3.6% each year for 27.5 years. So you can go ahead and tell the IRS that you deserve a $7,000 tax deduction because of depreciation. And also, it doesn't matter if your property value ends up going up or down, this tax break is based on your purchase price. But wait, I thought you were only making $6,400 in taxable income. And that's where the beauty lies. Even though you're actually walking away with $6,400 in rental income profit at the end of the year, in the IRS's eyes, you're actually losing $600 a year from the depreciation aspect. So in the end, you pay $0 on taxes on your rental income. And the next time you have to pay taxes, you can add that extra $600 as an additional deduction. That means over the next 27.5 years that you pay your mortgage off, you could technically never have to pay taxes on any of your rental income profit. But this is only the tip of the iceberg. As the value of your property goes up, you can then use it as leverage to borrow more money. Because as we mentioned in the second strategy, borrowed money is tax-free. So if your rental property's value jumps from $200,000 to $400,000, then you can leverage that extra $200,000 to take on debt to buy another property that you can essentially do the same thing to. Rinse and repeat. Now, the downside to all these strategies is they take time to actually execute. So here's something you can do today to lower your taxes. These are all tax-deferred strategic accounts that you can start now. First, 401k. It's a retirement account that your employer may offer that you can sign up for. You can contribute up to and reduce your taxable income by $22,500. Second is a solo 401k. It's like the 401k, but for people who work for themselves, like a business owner or a freelancer. You can contribute up to and reduce your taxable income by $61,000. Third is the traditional IRA. It's similar to the 401k, except you can open one up at any time, and you can contribute and reduce your taxable income by $6,500. Fourth is the HSA. It's a savings account that can be used to pay for current and future medical expenses like doctor visits or medicine. You can contribute up to and reduce your taxable income by $3,850. Next is the 457B plan for government employees, nonprofit organizations, and some for-profit companies. You can contribute up to and reduce your taxable income by $22,500. And believe it or not, some of these tax-deferred accounts are exactly how I started my financial journey a few years ago. Here's your tax guide, and now you need to learn how I became financially free by 26 by making these 7 small changes. I reveal everything in this video.